Well, hello everyone. Hope you're all doing well. And yes, there's a reason we have numbers surrounding me today. Today's chapter is on accounting, and can't talk about accounting without numbers. So you're going to be seeing numbers throughout today's lecture. But first, let's talk about what we have coming up. All right, so Chapter 12 quiz, Friday at midnight. Assuming you're used to the routine by now. Videos Monday and Wednesday, and then the quiz Friday. So same thing this week. And then our final business plan interim submission, which is on finance and administration. That'll be due next Wednesday, April 22nd. So that's it. You knock that out, and then all the interim submissions are done, and you just work on the final business plan. All right, so accounting. Number one, this is Chapter 12. There is no Chapter 11 that we're working on. That's why we just jumped from 10 to 12. So no Chapter 11 that we're covering. And there's just 2 chapters to go after this. We'll do 13 and 14, and that's it. Now, I know a number of you are interested in accounting. So this is your chapter. And if you're not, it's still important because as future managers and leaders, it's important that you understand the basics of accounting. And that's really what we're going to cover, just the basics. If you remember back to Chapter 5 and the reasons for small business failure, 2 of the 5, 1, cash problems, and 2, managerial inexperience and incompetence, both of those really trace back to accounting and people not really having a good grasp of accounting. So it's really important, whether you're interested in accounting or not, to understand the issues we're going to go through today and on Wednesday. So with that, let's take a look at what our learning objectives are for the chapter. And today we're going to cover these on the left-hand side. And we're also going to talk about 2 of the main 4 financial statements today. Okay, we'll cover just 2 today. And then we're also going to talk about the difference between cash basis and accrual accounting, because that really speaks to 2 of the financial statements. So that's our lessons for today. And as you know, we like to start with a question. So today's question is, what do they have in common? Take a look at each of those logos first and ask yourselves, what do these 1, 2, 3, 4, 5, 6, 7 organizations have in common? Well, 2 things, really. 1, you're likely to have heard of each of these. And 2, they've all had accounting issues recently. All of them. Theranos. You might have heard of Elizabeth Holmes, her business. This was the group where the thought was you could just take a drop of blood from a finger or a couple of drops and perform a whole bunch of tests on that, so you wouldn't need a needle to withdraw a lot of blood. Turns out that technology didn't really exist, and there's accusations that Elizabeth Holmes defrauded all these investors, that they looked at these financial statements and they were all fraudulent. And so she's now going to be going on trial later this year. She could be in jail for 20 years based on the accusation that she defrauded investors with the financial statements. WeWork. This company had grown tremendously and had a valuation of nearly $50 billion in 2019. They were going to go public, but once they published their financials for investors to look at them before they went public, there were all sorts of what were called creative accounting issues and governance issues. Governance speaks to how an organization is controlled or directed. And it turned out that the CEO had all sorts of conflicts of interest, that he had interests in buildings where WeWork was leasing space, that his shares of the business had 20-to-1 voting rights over other shares. He was borrowing stuff at a very small interest rate. He had family working all throughout the business. All sorts of issues with their financials. Huawei. Okay, this is the big Chinese telecom company that makes smartphones. They are in trouble for all sorts of bank and wire fraud by trying to circumvent the sanctions on Iran. They were also accused of trying to steal trade secrets from T-Mobile, so financial issues there. Under Armour was accused by the SEC of shifting sales quarter to quarter, so they're in trouble. Samsung, they've had executives arrested for obstructing an investigation into accounting fraud, bribery, embezzlement, hiding assets overseas. So big companies, all with massive recent accounting issues. And just so you don't think, those are, companies, that doesn't have anything to do with us, that wouldn't happen here. Well, I included Montgomery County, Maryland, and the Montgomery County Parent Teachers Association, the PTA of the public schools, for a reason. And that's because they have each had accounting issues very recently. And I'm going to show you them. So, Montgomery County. Montgomery County official pleads guilty to charges related to embezzlement. So this is from November of 2018. And this guy embezzled $6.7 million in county money to feed his gambling addiction. So, barely over a year ago. Okay? He was the chief operating officer of the county's economic development group. And, look at some of these quotes. "I'm appalled and shocked," said this person. "There should have clearly been more oversight. A combination of it. That's clear," said our county executive. So, Montgomery County, someone was able to embezzle just last year $6 million. And Montgomery County PTA, again, 2018, the largest PTA, or in Maryland's largest school system, stole $39,000, embezzled it. So again, with the financial statements, had fake financial statements and stole $39,000, and now will be going to jail. So, I don't want you to think that this stuff just happens to, other companies and couldn't happen here, because it could and it has. So important to understand the basics of accounting. All right, with that, let's talk about what accounting is. And there's a pretty good definition. And the term I want you to focus on here is communicating. Communicating, because that's what accounting does. It communicates results. It's what Warren Buffett is speaking about in his definition here. Accounting is the language of business. It's about communicating. So who do you communicate to? Well, there's two different branches of accounting. There's management accounting, okay, and that's communicating information to internal users to help them operate the business. And that's different from financial accounting, when that provides information to internal and external users, and that's more about assessing an organization's financial performance. So they're different. So let's go back to management accounting for a second. Who are some internal users that need accounting information? Well, owners of a company need it. Managers of a company need it. Even employees of a company, they need it as well. They all need accounting information, but can be for different things. Think if you're in human resources, HR. Well, you're interested in salaries, overtime. What is the total payroll? What if you're in operations? Well, you're more interested in what's the cost of these goods? What's the cost of the production of this? What if you're in sales? You're interested in things like, well, what's the cost of these items? How many sales did we have? What's our marketing budget moving forward? And if you're in management, you might be interested in all these things. So different groups are interested in different components of accounting in management accounting. Financial accounting. Who are some of the external users that need accounting information? Well, there's investors of the company, they're interested in. Creditors, the people that loan money to the business, are interested in. Vendors, the government, and potential clients. They want to make sure a company can perform, that they're not going to go under. If they've got warranties, they want to make sure you're going to be able to perform and come through on those warranties. So lots of external users in addition to internal users. And this next slide summarizes that pretty well. management accounting versus financial accounting. So let me ask you a question, and you tell me if this is a management or a financial accountant. You're working as an accountant for Montgomery College, and the president asks you, how much have we paid for IT equipment this year? Is that management accounting or financial accounting? Well, that's management accounting, right? Because it's internal and it speaks to operations. How are we operating the business? Now, second question. Let's say you work for Deloitte, one of the big four, and again, the president of Montgomery College now comes to you and asks you to audit the books for an annual report. Is that management or financial reporting? Yeah, that's financial reporting, because you're an external accountant. You work for Deloitte, not for Montgomery College, and you're going to be doing an audit for an annual report that's going to talk about Montgomery College's overall performance. So it's assessing financial performance. So that's the difference, again, between management and financial accounting. I mentioned the big four. Besides Deloitte, do you know who the others are and why they're called that? Well, besides Deloitte, there's PricewaterhouseCoopers, also known as PwC. There's Ernst & Young, also known as EY, and there's KPMG. And they're called the Big Four in accounting because they do the overwhelming majority of big firms' accounting. How much is that? Well, let's take a look. They did 497 of the S&P 500 companies. The Big Four did their financials. That's a lot. That's a lot. So, why do you think that is? Why do you think the Big Four did that many of the financials? Well, two reasons really. One, they have credibility. Everybody's heard of them, and it's important for all companies, particularly big ones, that people have faith in the numbers. So having credibility, important. Secondly, is really they have scale. They have size, and you need it if you're a huge company. Think of Marriott's financials. Okay, we like using Marriott as an example because they're right down the road. Think if you had to put together their financials for a year. Marriott has 30 different brands, as we've talked about. The Ritz, St. Regis, the Sheraton, the Renaissance, Westin, Courtyard, SpringHill Suites, Fairfield Inn, many more. You've got to roll up the financials of each of those brands into one set of statements. And just for one of those brands, they're probably in 50 states. They're probably in multiple countries with multiple currencies. All of that has to be rolled up into a single set of financial statements. So it's extraordinarily complex, and it takes a ton of people to do it. And so generally speaking, the big companies go to one of the Big Four for their financials. Now that still leaves a lot for smaller accounting firms, and there are a ton of regional and smaller accounting firms. There's smaller public companies, private companies, S-corps, LLCs, partnerships, sole proprietorships, all that we've talked about. So plenty of business to go around for the smaller firms. Now, it used to be a Big Five in accounting, not just a Big Four, but that changed. Anybody know why that changed? Well, back in 2002, Enron went under, and we've talked about that before. And Enron's accountant was Arthur Andersen, and they were a massive firm back then. They were founded in 1913 and were actually one of the world's largest companies. In 2001, they had 85,000 employees and about $9 billion of revenue. So huge. But because of the Enron implosion, they went under. And we've talked about Enron, so I thought I'd show you a short video. It's a minute that just explains what happened with Enron and why that was such a disaster. So let me see if I can pull that up.
Enron used to be the 7th largest corporation in the United States. at one point valued at over $70 billion. As of 1997, however, they started losing money and accumulating debt. Instead of admitting their mistakes and making changes, Enron executives decided to hide the losses through accounting tricks because they didn't want the Enron stock price to go down. Risky decisions kept being made, and the truth was hidden under the rug. As of 2001, however, the media started wondering whether or not Enron was overvalued. This obviously put a lot of pressure on Enron stock prices, which used to be as high as $90.75 per share. Insiders decided to cash out and started selling lots of shares, and prices kept falling until they ended up at below $1 in late 2001. In December 2001, Enron ultimately filed for bankruptcy. Approximately 20,000 jobs and $2 billion in employee retirement funds were lost. Many executives were brought to justice, and some of them ultimately ended up receiving prison sentences. Enron was an early example of just how recklessly some corporations are managed. We then had countless other examples, mainly in the financial industry, especially after the Great Recession of 2007 to 2008. Do you see a pattern?
So, I think that was pretty good. I mean, it's just a nice overview of, what happened. And it can happen, which is why I wanted to show you that. Okay, so with that, let's move on and talk about standards, accounting standards. Have you heard the terms GAAP or FASB? Because if you haven't, you will, because they're well-known terms in the business world. So let's talk about what they are. FASB stands for the Financial Accounting Standards Board, and that is the group that puts together GAAP, GAAP being generally accepted accounting principles. It's essentially what it says on the slide there. It's the accounting practices, rules, and standards that many companies use to report their financial results. So who has to use GAAP? Well, according to the SEC, if you're a public company in the United States, you have to use GAAP. You have to use that to put together your financials, your financial statements. Also, many private companies use GAAP because many contracts and creditors and investors require them to have their financial statements according to GAAP. So why doesn't everybody just use GAAP if it's such a well-known system? How come small companies, generally speaking, don't use it? Well, the reason is it's expensive to get accounting firms to certify your financials according to GAAP. It costs a lot more, and it's a very arduous process. And if you're just a small sole proprietorship, or if you're a partnership or a small group that's just looking at it for yourself and your partners, you really don't need all that. It's not going outside to anybody else. You just want to make sure your financials are compliant with what the IRS says, right? The IRS says you got to do this to pay your taxes. So you'll just bring in an accountant and tell them, we want to make sure that it's correct per the IRS. And you'll get something called an auditor's opinion, where they'll just certify, we've looked at these financials and they're accurate and they're free of misrepresentations according to us. So smaller firms, generally speaking, won't use GAAP. How about global firms? Do they have to use GAAP? Well, no. There's a different standard for companies outside the United States. And the International Accounting Standards Board is essentially the FASB of global companies. And the International Financial Reporting Standards are essentially the GAAP for non-U.S. companies. The same concept, where the IASB is the group that puts together IFRS. Okay? Similar concept for companies outside the United States. So you may ask yourselves, why don't we just use one standard? Wouldn't that be easier? Well, both of these groups, FASB and IASB, have had discussions, and at some point that might happen, but it's just not really a priority at this point to make that happen. Over time, will it? Probably, but at this time, they're different. They're very, very similar. There's more similarities than differences, but there are differences, and there's two different groups. So with that, let's move to financial statements. Okay, this is kind of the main subject matter for today. So first, let's talk about what financial statements are. They provide managers with essential information so you can evaluate your company's overall health. That's what they do. And this first bullet, important. Public companies must report these financial statements to the SEC at the end of each quarter and fiscal year. They have to be published so anybody can see it. And fiscal year is in italics. What is a fiscal year? How is that different from a calendar year? Well, a fiscal year is any 12-month period you choose to report your financials. It could be a calendar year, and in fact, about 2/3 of companies, their fiscal year is the calendar year. But that still leaves a lot where it isn't. So why don't all companies just use a calendar year? And the answer is because some businesses, their years don't line up with January through December. Think of a college. Perfect example. Generally speaking, when do students start and end a college year? Well, generally they get to school, they start in August, and then the year ends in May, right? So it would be kind of strange to start your financials in January and in December because you'd really be covering two different calendar years for students. And so for that reason, most colleges, including Montgomery College, have a July through June fiscal year. That way they can work on the financials in June when the students are away, and they publish them from July through June, so it just makes a lot more sense. Think of the NFL. When do you think their fiscal year would be? Again, it wouldn't make sense to go January through December, right? Because the season really gets going in August, and the Super Bowl is played in February. So for the NFL, they have an April through March fiscal year. Because they figure April, okay, so that's when free agency and the draft starts, and then it goes right through the Super Bowl in February. And so they have an April through March. Retailers, most retailers have a February through January fiscal year. Why is that? Because December is so big for many retailers in terms of sales, but returns of the stuff that are bought in December generally come in January. And so they want to make sure that those returns are matched in the same year as the sales. So many of them will have a February through January fiscal year. So that's what a fiscal year is, and why some companies don't have a January through December year for their financials. Materiality. So this is an important term for accountants because it comes to what should we include in our financial statements? Do you have to include every single thing? If Marriott changes the parking lot sweeping people at their headquarters, does anybody really care if you're looking to value Marriott? No, of course not. So the only thing that needs to be included in financial statements is anything that's material or relevant. And the standard is, would an investor have altered their actions if the information had been omitted? That's the standard called materiality to determine whether something should make the financial statements or not. Generally speaking, if you're not sure, just put it in, right? Put everything in. You can't put too much in there, but you can omit stuff. So materiality is making sure that the stuff that goes in there is material or relevant to people that would be looking at it. So with that, 4 financial statements, and we're going to talk about 2 today. The first 2, the balance sheet and the income statement. So first I thought I'd show you a little video. Again, it's a minute long that gives a quick overview of each of the financial statements. So let's see if I can bring that up.
the best businesses thrive because they are organized. Gear up for great with 4 types of financial statements. Number 1, the balance sheet. It provides a snapshot of your business on the day it was prepared, and it's split into 3 parts: your assets, liabilities, and equities. Number 2, an income statement tracks your company's revenue and expenses. The income statement reflects your business activity over a period of time. The term bottom line comes from an income statement. If the number is positive, your company is profitable. Number 3, a cash flow statement tracks money available for spending as it comes in and goes out. Bills get paid with cash, not revenue, so it's important to monitor your cash flow. The cash flow statement keeps track of 3 kinds of cash: operational, financing, and investing cash flow. Number 4, an equity statement shows changes in an owner's stake in the company. An equity statement is organized by whether the company is a partnership, a corporation, or another type of business structure. So gear up for great by getting your business organized.
So, pretty good overview. That's the 4 financial statements, and today we're going to talk about the balance sheet and the income statement, and then Wednesday we'll cover the other ones. So with that, let's start with the balance sheet. Okay, so the balance sheet is based on the accounting equation. This is one you got to know. The accounting equation is listed there. Assets equals liabilities plus stockholders' equity. And you'll also hear the terms owner's equity, shareholders' equity, stockholders' equity. It's all the same thing, right? Because if you own a share of stock, you're an owner. So shareholders' equity, stockholders' equity, owner's equity is all the same. And it's called a balance sheet because it has to balance. Assets always are going to equal liabilities plus owner's equity. Okay, I'm going to show you a balance sheet on the next slide, but that's the important part to remember. Assets equal liabilities plus owner's equity. And it details a firm's position at a point in time, at the end of the month, at the end of the quarter, at the end of the year, at a certain point in time. Okay, and that'll be important when I show you an income statement that's over a period of time instead of a point in time. So let's talk about what assets, liabilities, and owner's equity are. Assets is anything of value that a business owns. Like what? Well, things like cash, inventory that's to be sold, accounts receivable if people owe you money for buying your stuff, your plant, property, equipment, and the investments you have. It could be intangibles like patents or trademarks or copyrights that we talked about last chapter. All of those things are assets that a company owns. Okay, so what are liabilities? Liabilities are what a company owes. They've taken out a loan and they owe money. Okay, so it could be notes payable, loans payable. It could be wages that are still payable, taxes that are payable. Stuff that you owe is a liability. And therefore, owner's equity is what's left over. Okay? It's the owner's share of a company's assets. If you've got an asset, it's either coming from a liability because you took out a loan, or it's yours. It's owner's equity. It's because you paid for it out of your pocket. It's got to be one or the other. And I'm going to give you an example where we're going to go through that, and I think it'll make it very clear. Let's say you were going to buy a car for $20,000. How would that look on a balance sheet? Well, it depends on how you pay for it. Let's say you walked in and said, here's $20,000 cash for that car. Well, you would have an asset of $20,000, the car, right? Car's worth $20,000. Liabilities would be zero. You didn't take out a loan, but owner's equity would be $20,000 because you paid $20,000 in cash. So your balance sheet would look like $20,000 of assets, zero liabilities, and $20,000 of stockholders' equity because you paid $20,000 cash. Now let's say you took out a loan for $10,000 for the same car. Now what's your equation look like? Well, you still have a car for $20,000, so assets still $20,000. Now liabilities are $10,000. Took out a $10,000 loan. And your stockholders' equity is now $10,000 because that's how much you paid. So in that case, assets still $20,000, liabilities $10,000, stockholders' equity $10,000. Finally, let's say you just put down a $1,000 deposit for that $20,000 car. Now what's your accounting equation look like? Well, still have the $20,000 car. Now liabilities are $19,000 because you would have had to take out a $19,000 loan, and stockholders' equity is just $1,000. That's all you put down. So obviously, more stockholders' equity is better because you've paid that already and you don't owe it. Okay? So, with that explanation, let's take a look at a typical balance sheet, a very simple one. And here's one for what's called the college shop. That's the example we're going to be using for these financial statements. So, a balance sheet answers the question, what do we have? What do we have? And of what we have, how much do we owe on it? And how much do we own? Okay? So, assets. What do we have? We have $275,000 worth of assets in this example. We have $50,000 cash. We have $75,000 in inventory to be sold, and we have $150,000 in furniture, displays, and equipment. So what do we have? We have $275,000 of assets. And what do we owe? Well, we owe $25,000 this year and another $100,000 in the next 5 years. So we have liabilities of $125,000, which means we have owner's equity of $150,000. It has to balance. Okay? So the balance sheet answers that question. What do we have? How much of that do we owe? How much do we own? And as business owners, you need to know that. You've all got your own businesses for the business plan. You have to know what your assets are and how much you owe and how much you own, right? Well, the balance sheet is how you're going to determine that. Okay? Now, let's just take a look at assets, because assets are listed on a balance sheet in the order of liquidity. Liquidity. And liquidity is just a term that means how fast something can be turned into cash. If you're highly liquid, you are ready to pay cash for stuff. If you are illiquid, that means you may own things like a house or a car, but you don't have a lot of cash, you don't have a lot of stuff in your checking account, so you can't quickly turn stuff to cash. It takes time to sell a car. It takes time to sell a house. If that's all your assets, you're fairly illiquid. And so assets are listed in terms of how quickly they can be turned into cash. So current assets are listed first. Those are things that can become cash in a year. Cash is always first because it's already cash. Inventory can be sold to become cash. And then long-term assets are listed after. So current assets, a year or less, first. Long-term assets, second. Liabilities, the same thing. Current first, okay, things that will be paid off this year. Long-term after that, things that will be paid off after 1 year. Okay, so that's the order in which assets and liabilities are listed. Finally, owner's equity. Owner's equity is what's left over. There is one distinction I want to make, though, with owner's equity. If you're just a sole proprietorship, for instance, owner's equity is owner's equity. It's what's left over at the end of the day. Same with most partnerships, okay? Because remember, with most partnerships and sole proprietorships, you are the business. There's not a separate entity out there. You are the business. At the end of your fiscal year, the money goes into your pockets, right? With a corporation, that's different. That is a separate legal entity. And so owner's equity for corporations can be a little bit different. It's not just owner's equity. It can include things like stock, because corporations have stock, and something called retained earnings. Retained earnings, because corporations pay out dividends, right? We've talked about every quarter a company will look at their financials and say, all right, we're going to pay some dividends out to our owners. What's left over after paying those dividends is called retained earnings. And so for a corporation, owner's equity can include stock in their own company they own and retained earnings, the money that's left over after paying those dividends. Again, I'm going to use an example that I think will make this clear. And here it is. Pop quiz. Perfect example. And the reason it's called a pop quiz is I'm giving you the answers, right? The best type of quiz. So let's look at question number 1. ABC Corporation now, has assets of $5 million, common stock of $1 million, and retained earnings of $750,000. How much is ABC's total liabilities? Well, if you were given that question, you know that assets equals liabilities plus owner's equity, right? Assets are $5 million. Liabilities, we haven't talked about them, but owner's equity, $1 million in stock, $750,000 in retained earnings. Those are both owner's equity for a corporation. And so the answer would be $3,250,000 because it has to balance. So if you were given that question, you would just set it up like this, and you know that the answer for liabilities would have to be this. Let's do another question. Same type of concept. If total liabilities increase by $100,000 and stockholders' equity decreased by $40,000 during a time period, what would be the change in assets? Well, it's really solved the same way. Assets equals liabilities plus owner's equity. Okay? Liabilities went up by $100,000. Stockholders' equity went down by $40,000. Therefore, assets would have to increase by $60,000 to still balance. Okay? They'd have to increase by $60,000 to still balance. Make sense? It always has to balance. Let's look at 2 more, just to be sure. Okay. Jessica borrowed $25,000 from Eagle Bank. How does this impact the accounting equation? Well, again, let's start with the accounting equation. Assets equals liabilities plus owner's equity. Now, she borrowed $25,000, which means they gave her $25,000 in cash. Here you go. So, cash went up by $25,000. She now has a loan payable. She owes $25,000 to Eagle Bank. And we know a loan payable, that's a liability. You owe it. So, if that was the question, assets increased by $25,000. She got $25,000 cash from them. And liabilities increased by $25,000 because she now has a $25,000 loan. We didn't touch owner's equity. No impact. Finally, last question. James owns a print shop. He just bought a new printing press for $20,000 and he paid cash. How does that impact the accounting equation? Well, take a look at it and see if you can figure that out. Well, let's see. He bought a printing press. We know that that's an asset. That's equipment that he uses now. So his assets went up by $20,000 and that was a printing press. He paid cash, right? So no liability. He paid cash. So cash went down by $20,000. Cash is an asset. So for this, his assets went up by 20 for the equipment, and then they went down by 20 because he paid cash. No change in liabilities, no change in owner's equity. All you're doing is moving the assets around. Excuse me. There's $20,000 less in cash, and there's $20,000 more in equipment. So again, any questions you get like this or see like this, just go back to the original equation. Assets equals liabilities plus owner's equity. You know it has to balance, and you do the math. You do the math. With that, let's talk about the final statement of the day, and that is the income statement. The income statement. Okay. So, an income statement is a summary of a company's revenues, expenses, and profits or losses over a period of time. a period of time. Okay? So, whereas the balance sheet asks the question, what do we have? What do we own versus what do we owe? The income statement answers the question, how much did we make? That's a different question. How much did we make in a certain period? And to know that, you look at, here's all the revenue that came in the door, here's all the expenses that went out the door, and here's the bottom line. We made a profit if revenues are more than expenses. We had a loss if expenses are more than revenues. Okay? And it's a period of time because that makes sense. You can't say what was our revenues and expenses at the end of the month. Well, for how long? A month, a quarter, a year? So it's a period of time. What's our income statement for the month, for the quarter, for the year? It's a period of time as opposed to a point in time. A point in time. You'll also sometimes hear an income statement referred to as a profit and loss statement, a P&L, because that's the bottom line. Did we make a profit or did we have a loss? And I'm going to show you an income statement in a second that'll make that clear. So, revenues is all the money that comes in the door. Generally, that's mostly from sales, okay? But not necessarily all from sales. Where else could money come in the door if it's not from sales? Let's take the example of McDonald's. Most of McDonald's revenue is from selling burgers and fries and drinks and things, right? But how else might they get money? Well, we know McDonald's is a franchisor, so they get franchise fees. They could potentially sell a warehouse, right, and get money from that. That's not sales of burgers, but that's still money coming in the door. They might have investments, right? They could be getting interest or returns on their investments. What if there's a lawsuit, some litigation, and they win that, and they get money from that? So revenues is all the money that comes in the door. It's mostly sales, but it includes other things as well. Okay? Now, before I show you that income statement, there's one term that's important to know, and that is accrual accounting. Accrual accounting. There's two main types of accounting, accrual accounting and cash accounting. And the difference is cash accounting recognizes transactions whenever the cash changes hands. Okay? Accrual accounting is different. It recognizes revenues and expenses when they occur, which may or may not be when the cash changes hands. Because of the use of credit and loans, transactions occur that don't necessarily include cash, right? So in accrual accounting, as soon as something is sold, the whole transaction goes on the books. In accrual accounting, as soon as you buy something, the whole transaction goes on the books. Doesn't matter if it was paid for in cash or not. The whole transaction goes on the books. Why? Why do we even have accrual accounting? Well, there's a number of good reasons. One, it's required by GAAP. GAAP requires that you use accrual accounting. So all public companies and a lot of private companies, they have to use it. The IRS requires it if you're a private company and if you have any inventory at all or any sales over $5 million, you have to use accrual accounting. That's a lot. So the overwhelming majority of businesses use accrual accounting. Almost everyone uses accrual accounting. Again, you're probably asking why. And the answer is because it really gives you a much truer view of how you're doing. That as soon as something occurs, it goes on your books. Okay? You don't necessarily get that with cash. Because of loans, because of credit, stuff might not show up, might not come in. It just doesn't give you a very clear, true picture when you use cash. That's why accrual accounting is really the standard in accounting. Okay? So again, accrual accounting is when a transaction occurs, it goes on the books, which is not necessarily when the cash changes hands. Okay, with that, let's go to the final slide of the day, which is showing you an income statement. And there it is. So again, income statement answers the question, how much did we make over what period? So for this one, it's for the year ended December 31st. So we know this is an income statement for a year's period. Okay, so let's walk through it. Let's walk through it. Sales, $500,000. They didn't have any other revenue. It was all sales. Next, you deduct cost of goods sold. So for them, $275,000. That's their variable expenses. Remember in the lemonade stand, right? There were fixed and variable expenses in a break-even analysis. And we use the example of Subway, where variable expenses were things like the meat and the lettuce and the tomatoes and the plates and the cups and napkins. Variable expenses change with sales. And so in an income statement, you have to break your expenses essentially into variable and fixed. And you have to do this for your business plans. You need to put together an income statement for your business. And your income statements and your business plans are going to look very much like this income statement. So doubly important to know this. So again, you start with what your total sales are for the year. That's the top line, your revenue. Now you start subtracting. First, your variable expenses, $275,000. So now you have $225,000 left over. That's called your gross profit, $225,000. Now what do you expect? Subtract your fixed expenses. Okay? These items here are your fixed expenses that generally don't change with your amount of sales. Salaries, depreciation, your rent, your utilities, your advertising, your insurance, all that are your fixed expenses. So now you have to subtract that. So $225 minus your operating expenses, your fixed expenses of $175. Now you have $50,000 left over. That's called your operating income, $50,000. Now what do you subtract? Well, if you've taken out a loan, you got to subtract that. So you're all going to have to take out loans. What do you subtract? Well, whatever you're going to pay in that year is what you subtract. For this example, they took out a loan of $125,000 at 8%. So $125,000 times 8% is $10,000. That's how much they paid in interest for that year. So here you're going to subtract it. 50 minus 10 is 40. And then the last thing you're going to subtract is your taxes. And in this example, $40,000, it's 25% income tax rate. So you take $40,000 times 25%, that's $10,000. You subtract that, and your bottom line is $30,000. So the college shop at the end of the day had net income of $30,000 for that year. That was their profit. And as it said in the video, that's where the term, the bottom line, comes from. Okay? It comes from an income statement. I don't want to hear it. I just want to know the bottom line. Did I make it a profit or did I make a loss? And here they made a profit of $30,000. The bottom line. So with that, I know it was a lot of numbers today, but it all makes sense and it's important to know. So I'm hoping you're grasping this information. And as always, if you have questions on anything, just send me an email. Happy to answer it. Happy to answer it. And the slides are online. I think if you look through the slides, all this stuff makes sense. It'll make sense. So again, we'll cover the second half of accounting on Wednesday. We'll look at the other two financial statements. Okay? So with that, stay safe, everyone. Take care, and we'll be in touch with you again on Wednesday.